Do you agree with that view? Have we seen peak inflation?
I think it's too soon to say, Haslinda. Clearly, we saw a very positive data point last week. U.S. inflation certainly on a sequential basis seems to have peaked in the short term. I think what we have to consider is how inflation looks in this cycle, which is very different from previous cycles. It's not really demand-driven inflation. It's a lot of supply-driven issues, whether it's energy, food, employment, wages. So I think it might be too soon to say we've peaked. And even if we have peaked, I think we have to consider the fact that inflation is probably going to stay elevated for some time for all these reasons, because the supply issues are yet to be resolved. So even if the Fed does ease up on its monetary tightening, interest rates are probably going to stay high for a while, and we need to consider what that means for markets.
We also have to consider China easing its COVID restrictions, with China back in the game, opening up, demand will rise, and that may send prices spiraling.
We're of the view that China is on a slow path to easing, both in terms of COVID policy as well as other monetary policy. You've seen some of their administrative measures on real estate be eased as well over the last few months. And you're right, when China opens up, we've seen the reopening trade in the US, we've seen the reopening trade in Europe, you've seen what's happened in Asia. We know how long China has been locked down for. It has been a couple of years. There's a lot of pent-up demand. There's a lot of businesses that rely on China. So I agree, when China opens up, we do need to consider what it means for demand, what it means for services, what it means for capacity in terms of cargo, and obviously energy, jet fuel, and so on. So the Fed and other central banks will have to consider the likelihood that as China opens up, inflation may just spike a little in the medium term, in the short to medium term, and how they react to that, whether they see that as something to be concerned about or not.
Some views here at the New Economy Forum suggesting that China is back being investable. Is it a good time to be picking up? Are there values to be had right now?
We believe so. I think you can't ignore the long-term growth in China. You can't ignore the fact that China's been locked down for 2 years now. As you say, valuations are low by any comparison relative to its own history, relative to the rest of the world. When you see what's happened in the last few weeks, you've seen the Communist Party Congress come to a conclusion. There was a lot of speculation that the political overhang was driving policy. Now that that's out of the way, I think the leadership in China has to consider the ramifications of keeping the country locked down, because the economic risks are going to continue to be high.
The question is, Manraj, where is value right now in China?
I think it's in a whole range of areas. I think the consumer is still a very attractive part of the economy. When you think about the consumer who's been restricted in what they can do, what they can spend over the last couple of years, so there's a lot of value in the consumer. We still think the premiumization of the consumer in China is a long-term growth story. That is a sector that's been beaten down. Another area that we like and have continued to favor for some time is the whole electrification of the transportation system. Whether you're looking at electric cars, you're looking at battery technology. There are a number of areas around the world where China is not a leader. Electrification, greenification of the economy is certainly not one of them. China is a leader in those areas, and with a lot of money having come out of China in the last couple of years, those valuations have been beaten down. So that's an area we're looking at as well. So there are a whole range of areas.
When you take a look at the broader market, there have been huge swings, suggesting perhaps great dislocations within the markets. Where are you seeing opportunities?
Well, I think it's probably too soon to say, but you look at what's happened over the last week. You've had a couple of key events. First of all, you've had this apparently positive inflation print in the US. You've seen relaxation of some COVID measures in China, maybe not very meaningful, but some relaxation certainly heading in the right direction. And thirdly, we had a very important meeting yesterday between President Xi and President Biden. Now, a 3-hour meeting is meaningful. Whilst you can't draw too many positives out of one meeting, I think it does set a floor in terms of relations. It was a relatively benign meeting. So you've got a couple of events that are happening now in the world at the same time, which suggests this could be a bit of an inflection point. And if that is true, whether China is opening up and going to see a recovery in growth and perhaps capital coming back in, whether you're seeing us being closer to the peak in the U.S. interest rate cycle, and indeed inflation calming down. All of that means that what's happened in the last 12 months is probably not going to continue into 2023. So we need to see what's going to be different next year. And if that's true, I think the rest of the world will see capital flows, we'll see capital coming in. A lot of the rest of the world has seen markets suffer. The U.S. has done much better. There are obviously some exceptions. So we think, by and large, it's going to be better to make money outside of the U.S. rather than in the U.S. in 2023.
Big question mark for Europe, though, right? I mean, let's take a look at the bond market. Bonds finally giving returns the first time possibly in about 10 years. Would it be bonds in the developed markets that are more attractive to you?
Potentially. I think we're at this very interesting point in the cycle where rates are potentially peaking, valuations are potentially bottoming, but fundamentals are getting worse. Right? You look at the releases from a lot of companies, not just in the US but elsewhere last week. Job cuts abound. The economy is going to see a reflection of that in terms of consumer spending. So the Fed action and other action is taking an effect on the economy. So the markets are going to have to take a view of how deep and how long this recession is going to be. And there will be a recession in 2023. We don't think it's going to be a very long one. We don't think it's going to be a very deep one. But it also is going to be a recession where certain parts of the economy and certain parts of the markets are not going to feel like they're going through a lot of pain. Compared to previous slowdowns, consumer balance sheets are stronger. Bank balance sheets are certainly stronger than the global financial crisis, and similarly corporate balance sheets. So this is a very different slowdown, and investors are going to have to look through what happens as things deteriorate in the first half of next year, but look for the recovery into the end of 2023. So you're right, bonds are an interesting place to hide now, particularly in the developed world. Europe is going to continue to go through a tough period, which means we need to look beyond that outside of the US.
Manraj, I mean, cryptos have really caused quite a stir. Retail investors have been pretty much burned. Is that impacting sentiment in the market and liquidity in the market?
I don't think so. I think whatever's happening in the crypto space is interesting. It's going to be an interesting phase in the evolution of crypto, whether it's in the retail space or elsewhere. But I don't think it's affecting sentiment significantly. I think it's quite contained right now. And the broader market is still seeing a lot of liquidity. And the authorities, I think, will be there to address any issues in crypto. But I feel it's quite contained.